Lithium, the third element on the periodic table, and fast becoming one of the world's primary energy storage mediums. But what you need to know about it, and why am I investing in it? Stay tuned to find out. Just before we get started, I want to say a massive thank you to everybody that subscribed over the last week. We're quickly closing on 150, so hopefully we can hit that before the end of the month. In my end of year portfolio review, there was one clear stock that was an outlier from the rest, and that was SQM. They were up around 90%, massively outperforming any other stock within inside my portfolio. But there's been some recent political changes that have changed my stance on this particular stock. So what I want to do is have a look at the lithium market as a whole, have a look at SQM, and have a look at what I'm going to do given these changes. So why am I investing in lithium-based mining stocks? Well, there's a number of reasons. First and foremost, the one that's the most obvious is the growing EV market. In 2016, there were 750,000 electric vehicles sold. Last year, that grew to 6.3 million. That's a growth of 740%. And in 2026, we're looking to see growth up to another 20 million vehicles. This is rapidly eating into the market sector, which is currently dominated by internal combustion engines. And given that the average battery vehicle takes between 7 and 10 kilograms of lithium, there's going to be a massive increase in the demand for lithium mining. Part of the reason for the growth in the EV market sector is not just people being more environmentally conscious, but also the fact that the price of electric vehicles is coming down. The battery packs are getting cheaper to make, and therefore the vehicle overall is getting cheaper to produce. If the EV market is growing so heavily, why don't I just invest in EV automakers? Tesla, for example. Well, that market sector is highly competitive. You've got original manufacturers such as Volkswagen and Ford going up against new companies such as Tesla, and even tech companies emerging into the vehicle market such as Google and Apple with potential vehicles coming out. This sector is highly competitive, and that competitive nature makes the investments more risky. So part of that train of thinking, I thought to myself, well, why don't I just invest in the underlying asset that's going to be driving that market? Lithium. You need lithium to produce electric vehicles, and there's no technological revolution going on with lithium mining, so it makes that market sector as a whole far less risky while still giving you the growth of the EV market. There's a couple of other reasons for the growth in lithium demand that aren't always as considered. The first being the continuous growth of the consumer tech market. People are buying more phones, people are buying more tablets, people are buying more portable electronic devices, and most of those devices are powered by lithium-ion batteries. Now, yes, these batteries use considerably less lithium than an electric vehicle would, but it is still leading to overall growth in the demand of lithium. Another area which is being considerably more overlooked is grid storage. As we move to renewable energy generation such as wind and solar, it adds inherently more instability to the grid. For anybody that may have covered it, there's something called the duck effect. This is where the solar demand drops off towards the evening just as the peak energy demand rises on the grid. This leads to a steeper rise in demand, which conventional fossil fuel powered power stations aren't able to ramp up as quickly to meet. Not only that, wind power isn't consistent. The wind doesn't blow the same speed all the time, and it leads to fluctuations in the energy supply on the grid. To smooth this demand, we need to increase the amount of energy storage on the grid. Now, there's a number of ways of doing this. We can do it with hydro, we can do it with gravity, but a lot of it might be battery powered storage, which is going to require lithium powered batteries. This has led to the following predictions in the growth of lithium demand. In 2016, the requirements was 200,000 metric tons a year, but they're predicting now that the demand will grow ninefold in 2030 to 1.8 million tons. This leads to massive growth in the lithium mining sector, and thus profitability options for investors. Now, before investing in any lithium mining companies, there's a few things you need to understand about the market. The first, and arguably one of the most important ones, is that there's only a few players in the game due to the number of reserves available in the world. Because the location of reserves are so few and far between and distributed across just a few countries, the risk of political problems stemming from its supply are quite high. This is a point we're going to expand on more when we look at SQM as a stock. Now, there are two forms of mining lithium. You have brine mining and you have hard rock mining. Brine mining is cheaper and involves pumping minerals out of the ground using water. Hard rock mining is a lot more costly and is mainly done within inside Australia. Hard rock mining in Australia has been the largest growing part of the market. Australia now make up 49% of the global supply of lithium. This used to be dominated by Chile with their cheaper brine mining, and given the fact that they have 57% of the world's reserves, you would have expected this to continue. But due to the political issues we're going to look at further on in the episode, this has had a massive impact on their share in the market. Well, what about the actual fundamental price of lithium? We're investors, we like charts. The chart on screen tells a tale in itself. In 2018, 2019, There was a huge growth in the demand for lithium as EVs started to come online. Suppliers therefore started producing vast amounts more lithium and opening up more brine and hard rock mines. Unfortunately, as the electric vehicle revolution was not quite as quick as people expected, this led to an oversupply of lithium in the market, and thus the price of the commodity dropped. Eventually, some of the biggest players in lithium mining came together to try and control the supply into the market and thus stabilise the price. They managed to achieve this, but unfortunately, things then went the other way. The demand for electric vehicles suddenly rapidly climbed, and there was not enough supply on the market to meet the demand. Therefore, the wholesale price over the last few months has rapidly soared. The cost for the average tonne of lithium carbonate has soared to over 300,000 yen, or around £36,000. This is a blessing and curse for the miners. It's great in the short term because they make more money due to the high wholesale price. However, in the long term, higher lithium prices slows down the development in battery tech. It also increases the price of battery packs and therefore puts customers off buying electric vehicles. This delays future profit from increased demand of lithium in the future. The higher wholesale price also encourages more miners to enter the market, as this is a profitable venture, and therefore it reduces the market sector of the miners who are already at play. So before we look at SQM as a company and the political issues around it, I want to give you full disclosure as always. I hold 66 shares in SQM. I bought these a couple of years ago for the reasons I spoke about at the start of this video. Due to the growing demand and the increasing hold price, these shares have massively outperformed the rest of my portfolio at nearly plus 92%. So I'm just going to do a quick summary about SQM as a company. This isn't going to be as much of a deeper dive as my normal stock reviews episode because I'm more interested in the political issues going on around the company. SQM is a Chilean-based brine mining company, which I previously mentioned. They don't just mine lithium, they also mine for iodine and potassium and produce some industrial chemicals as well. Currently, they're the second biggest miner of lithium, producing about 17% of the world's supply. We spoke about this stock massively outperforming the rest of my portfolio, and it's clear to see why. Their Q3 profits for 2021 were up 96% on their 2020 values. This was heavily driven by the growth in lithium, adding 64 million to their profit margin. Being a dividend investor, I always look at the dividend yield, and it's fairly low for this company at 1%, and that just shows the strength that this company's been going through in recent years. So, if the demand for lithium has grown so much, and SQM are performing so well because of that, why am I now concerned about this stock and considering selling it? Well, to understand that, unfortunately, we have to look into the political situation inside Chile. At the end of last year, Chile held elections, and there was a surprise result that came out of that. Now, unfortunately, my Spanish pronunciation is terrible, so I'm going to refer to the party by their UK name, the Improved Dignity Party. This is a party from the far left led by a gentleman called Gabriel Boric. Now, one of Boric's policy ambitions is to have a state-owned national lithium corporation that will be in charge of developing the lithium industry. Politicians in Chile and a number of other countries have tried to achieve privatization of mining sectors before, and historically this has never ended well. State-owned companies are owned and directed by the government. Governments aren't mining experts, and therefore the companies tend to be less well run than if they were in private hands. This generally means a state-owned company is less competitive on a global scale and leads to the downfall of the company. Now, there's a number of ways that people are predicting Gabriel Boric might try and control the lithium industry within Chile. On the lighter side, he might introduce higher taxes on companies that mine lithium. This would increase the government's revenue and reduce the profitability of the companies, but ultimately wouldn't have such a big impact as trying to privatise the whole industry. On the medium side, they could cancel some of SQM's mining concessions and make them state-owned. For anybody that's unfamiliar, a concession is effectively a right that allows the company to mine the land. And on the heavier side of things, we could see the government try and completely expropriate SQM and all of its assets. Now, we don't actually know how the Improved Dignity Party might go around this, but it's definitely a risk that we need to consider as investors. This isn't an idle threat either, as we've seen recent news come out of Chile. Lawmakers asked the court to stop bidding on a couple of mining contracts that were due to go up at the start of this year. Thankfully, the court didn't rule on the side of the lawmakers and continued to issue those contracts, though they weren't awarded to SQM. However, it's clear to see that this new government is being very proactive about trying to profit off the lithium mining inside the country. So what effect did all of this political turmoil having? Well, first of all, a prominent member of the board resigned. This isn't a positive sign, as it clearly shows that a prominent member of SQM is concerned about the effect the government could have on the company. We can also see the worry in the markets. The appointment of Gabriel to the office led to a 35% sell-off in the shares over a number of days, although we have seen the share price recover by 20% since then. One of the more contentious points was the surprise special dividend. At the end of December, at very short notice, the company announced it was going to pay out a $1.40 dividend for every share you held. This was completely against their well-defined dividend policy and equated to almost 100% of the earnings for 2021. Even with their bumper profits last year, it didn't warrant paying out such a large dividend. and it begs the question that are shareholders trying to remove equity from the company before the government is able to take it over? Certainly want to keep an eye on, as there could be insiders that know far more information than we do that led to this move. So what am I doing about all of this political effect on the lithium mining section of my portfolio? Well, first of all, I want to stay invested in the lithium mining sector. For the reasons we spoke about at the start of the video, the demand is massive. Therefore, the growth and the investment growth will also be massive. Due to the amount of this growth that's coming out of Australia, I would like to be able to invest in Australian stocks. Unfortunately, as an overseas investor, investing in Australian stocks is pretty much impossible. One thing I will be looking at is whether the recent UK-Australian free trade agreement might allow UK investors to invest in Australian companies. Another way I might try and invest is look into Chinese stocks. However, that's also somewhat difficult to be able to invest in. As I spoke about at the start of the video, due to how few players are on the game, most of the other stocks available to UK investors are small or don't yield a dividend. This doesn't mean they're going to be bad investments and that they won't yield growth, but it does present a much higher risk as these companies are not yet set in their ways. What I will be doing is evaluating my position in SQM. I'll keep an eye on the political situation in Chile, and if I deem it too risky, I might get rid of the stock. In the coming weeks, I'll be doing an episode on SQM versus Albemarle. So if you're interested in that, please do consider subscribing. Albemarle is the biggest supplier in lithium. They supply 19% of the world's supply. Due to the fact that 57% of the world's reserves of lithium is in Chile, Albemarle do still have mines there. However, they have a much more diversified portfolio of mines across the world, and therefore the political situation in Chile will have a lesser impact on them than it will do on SQM. What I'll also be doing is looking into lithium ETFs such as LIT. LIT is an ETF that holds many companies based on lithium mining, electric vehicles and battery tech, and presents a much more diverse way of investing inside the lithium market. Now, the LIT ETF does hold both SQM and Albemarle, but due to its diversification, it presents much less risk. Well, I do hope you've enjoyed this episode, and I want to wish you a great week going forward. See ya.